Several stocks popular with options traders reporting earnings this week imply some pretty big moves. Disney is one of them. We'll look at what options traders were betting on today. That and your questions and perhaps some other earnings look ahead today on Open Interest. Hello everybody, I'm Mike Coe. Welcome to Open Mic. Disney traded nearly 5 times its average daily options volume today. Calls outpaced puts, not as much as it usually does. The options market right now is implying a 6% move, higher or lower by the end of this week. And while that is higher than the long-term average earnings-related move, Disney has been quite volatile recently. It jumped 11.5% following their Q1 earnings release that happened on February 7th. Consensus estimates are for $1.10 a share on approximately $22.1 billion in revenues, which would represent a modest 1.3% year-on-year increase. Company management successfully defended against moves by activist investor Nelson Peltz at their April 3rd shareholder meeting. And the company guided to between 5.5 and 6 million Disney Plus subscriber gains. Streaming services have not yet reached profitability, but as Julie Beal commented on Fast Money last Friday, while a lot of attention is directed at streaming, Disney's experience segments, which would include their theme parks, resorts, vacations, and merchandising, is a much larger contributor to revenues and profits than subscriber revenues are. For full year 2023, ended September 30th, experiences revenues were about $32.5 billion versus about $16.4 billion for all subscriber fees. Now, Disney has rallied over 43% off of the lows that we saw last October, but it's trading about 24 times full year 2024 earnings estimates. Disney's fiscal year, which you probably just gathered from what I said before, actually ends in September. And it's reasonable that if the street estimates of 20% or so for a CAGR, for their compound annual growth rate over the next couple of years prove true, that these valuations are not unreasonable. So the most active contract that we saw today were the weekly 110 puts. And we saw a little over 10,000 of those trading. The average price for those contracts was, let's just see what it worked out to, about $1.27 a share. I'm curious, so I'm just going to quickly check and see how much of that was actually institutional flows versus retail. So we did see a couple decent-sized prints, including a purchase of a little over 2,500 of those for $1.45. That took place just before 10 o'clock this morning when the stock was trading about $1.15.45. Like I said, calls did outpace puts overall. So let's take a look at, first of all, this put trade and how that would stack up. So if we're going to take a look at just a quick chart of Disney, you can see the sharp rally that we've had off of this October 27th low. Stock was trading 79.07. It's obviously gained significantly since that time. Now, if you buy those 110 puts, the big print was $1.45. I think the average was a little bit less than that. You get a payoff that looks sort of like this, right? So the stock is right here right now. Obviously has to decline. The red you can see is much smaller than the green, indicating that you're going to lay out a relatively small amount of premium, but your gains are potentially quite substantial if you get a really big decrease. But you can see that that downside break even is going to be down here. And actually, I can combine that chart with a price chart, give you a sense of just how far the stock would need to fall before that put is actually going to start contributing any profits. If we're just taking a look over here, we can see that's going to get us down in this region right here. That represents essentially the lows of last week. So a question one might ask themselves, okay, does it make a lot of sense to buy puts to insure against a potential decline in Disney following earnings? My thinking is probably not, but if you were inclined to try and do something with your long equity position, maybe a better trade would be something like a put spread, essentially looking for a little bit of a give back. Now, I'm pointing out that at the moment we're looking at this essentially for illustrative purposes. We're going to take a look at some of the names that are reporting. Why am I saying for illustrative purposes only? Well, because Disney reports tomorrow, but I believe they're actually reporting pre-open. So it's going to be a pre-market report, and we're looking for $1.10 a share, as I previously said. But you're not really going to be able to act on it ahead of that. We have a couple big names that are going to be reporting that are expecting moves at least as big, and we are going to be able to take a look at some of those while there still is time to act on them. That would include names like Lyft, Uber. We've got Affirm Holdings in there. Robinhood, which if memory serves, I think they got a notice from the SEC today on the crypto side. We can take a look at that. Unity Software, and then towards the end of the week, Marathon Digital. Okay, so again, I'm just going to show this combined chart again for a second, so you can see where that kicks in. I suppose that's a cheap way somebody could be looking at a cheap way to bet that this gap that we saw here when they reported their last earnings result, that could fill for whatever reason. I still would have preferred, I think, to trade a put spread instead. So maybe I can actually put a put spread in here, kind of along the lines of what I think would have arguably made a little bit more sense. So like I said, that the biggest print in those was $1.45. You could actually spend, a relatively similar amount of money to buy a put spread. And in fact, I'm actually going to just quickly put this in. So this is a little bit more. I was just looking at, say, a 115, 110 put spread. That trade would cost about the same amount as those puts would. Difference is that they would kick in a lot higher. And where you can see this a little bit better, you can see obviously you don't get the same kind of max gain because of course your gains are going to be capped by the fact that you're selling that lower strike put. But what you can see here is you may remember that when we were looking at the 110 put outright, it wasn't going to see any profits unless the stock dropped below this level, which essentially was last week's low. Okay, I can kind of see that. But this one obviously is going to require a lot less of a move. It needs to just simply drop below that 115 strike by the total amount of premium spent, which is going to be less than $2. So your break even is going to be 113 and change. Stock closed 116.47. So let's just call it 113. I don't know, 113.25 for the sake of argument. Depends on where this options were priced at the time you happen to look at it. That's a decrease of 2.75%. And like I also mentioned, Disney has had some pretty big moves lately. Actually, we can bring up a table of those moves here on my other screen. Hopefully we can blow this up just a little bit. You can get a slightly better look at it. So these moves that you see over here that I'm indicating with my cursor, tough to make out, I know. So if you can't read it, I'll just read these off to you so you can know what I'm talking about. When they reported on February 7th, that was their Q1 24 results. The stock was up 11.5%. That was just that day. Quarter before that, stock rose 6.9%. It was up almost 5% before that. Had a decline of about 8.73%. Now, a quick point, too, I would like to make here, and that is that if you're looking at doing a trade like this, it's fine to look at the one-day move. Also try to look at these moves a little bit more in the context of how long the options trade you are putting on has until maturity. Now, in this particular case, we're just talking about weeklies. So we're really looking at from, call it 1 day prior, that would be today, to, I'll call it 4 days later. And why am I going to say 4? It's because they report before the open. So we can see that these moves, most of the moves that we're really talking about took place on that earnings day. So like I said, stock popped 11.5% or so the day they reported. For that week, it was 11.25%. Just under 8% popped the preceding. But you can see this thing actually has moved around quite a lot. over the long term, the moves were typically much more muted. If you go back in time, there were a couple big moves. We had this one back in early 2015, and there was a big move lower, I think. Yeah, here it was in August of 2015. I remember that because we were actually taking a look at the stock beforehand. That was kind of a meaningful disappointment. Okay. Oh, by the way, I should say this at the beginning of every single one of these, but I sometimes neglect to. Be sure to, if you have a name you want to look at, whether you want to look at a name that just reported earnings, you have a trade, you'd kind of like to deal with it forensically or just looking for ideas, or if you are looking ahead to an upcoming earnings, you want to know either something about it, when it's expected, what the street's looking for, what the options flows we're seeing seem to be betting on, put it into the live chat, and I'll see it, and that'll be the way to do that. So, maybe I know the stock, maybe I don't know the stock. If I don't know the stock, we can try to take a look at it together, see what's going on. Okay, so let's take a quick peek here. I'm just going to mention this, and actually, you know what? Maybe we can do a little bit of a poll. I can mention some of the names that have upcoming earnings this week that are after tomorrow morning, so that we actually have an opportunity to review them properly while it's still time to act on them. And I'm just going to look at the ones that have a lot of open interest, a lot of flow, because the likelihood that one of you watching is involved in one of the names I'm about to mention is much higher than some completely off the run type of name. So other names that are reporting before the market, so we're not going to talk about Celsius Holdings. They report before the open tomorrow. Datadog also is going to be reporting before the open. Both of those are implying some pretty big moves. Celsius is implying a move of about 12.4%, Datadog about 11%. But after the close tomorrow, we've got Rivian. Rivian could be an interesting one to take a look at. There was news that was released today that Fisker Automotive, which is based in Manhattan Beach, another EV company, that they are actually going to be closing their headquarters. So obviously that's kind of grim. We have Arista Networks after the close tomorrow, Twilio, Coupang after the close. Lyft is going to be reporting after the close tomorrow, implying, wow, look at that, 17.5% move, or at least that was when I did this great. And Uber before the open the day after on Wednesday. So that both of those could be good ones to take a look at. Let's see what else we have here. Affirm Holdings, Robinhood. Oh, Robinhood also, there was some news on that one, so we may want to take a look at that. I believe that they received an SEC notice. We want to investigate what's going on there. I don't know if that's a bigger story or not. Airbnb coming up on the 8th after the close. HubSpot, Trade Desk, Roblox, Unity, and Marathon Digital. This pretty much, by the way, just so if you're wondering what this is a list of, what I did was I just took a look at all of the companies that are reporting earnings this week. I looked at all of those where the options markets were implying a move of 5% or more. And then I distilled that list down by taking a look at companies that trade north of 75 million a day notionally on the option side. So what does that mean? I speak to a lot of people, and they are sometimes confused about whether options volume matters or it doesn't matter. What constitutes a lot? I mean, if a stock trades 100 contracts a day and then it trades 200, the volume has doubled, but does that mean it's really worth talking about? Well, what I'm interested in is I take the total contracts that trade on any given day on average. I also look at the open interest. And I multiply that by the stock price and multiplier. Why do I multiply by the stock price? Because 1,000 contracts in a name like Booking, BKNG, Bravo Kilo November Golf, which was formerly known as Priceline. that is a stock that costs thousands of dollars. So 1,000 contracts of a $3,400 stock or whatever it is. It looks like Uber, Hood, WYNN. Okay, so looks like we're getting some people who are interested in a couple of these. And so we will definitely take a look at that. So when you're looking at volume, look at it in the context of the stock's price. The other thing I'm interested in knowing is, are the volumes that we're dealing with significant relative to the amount of stock that trades? If a stock trades 10 million shares a day and it trades 1,000 options contracts a day, the price action in the underlying stock may arguably be more important than really what's going on the options side. There's just not a lot of bets being made. On the other hand, if a lot of options contracts trade relative to the stock, and remember you have to factor that multiplier, then it matters. In Disney's case, Disney traded just short of 16 million shares today, something like that. We'll call it 16 million round numbers. And it traded 276,000 options contracts, which is the equivalent of 27.6 million shares of stock. So effectively, options traded on nearly double the amount of shares as actual shares traded. And since we know that some of that share volume was trading in response to the options volume, we can surmise that the options volumes are a significant barometer with respect to what options traders' sentiments actually are. Okay. So let's go through some of these questions and then try to get to some of the ones that have earnings. And we're going to try to, producers Brad and Jay, if you guys find that I'm just lagging too much, then bring it up, and we'll try to punch through it. Okay, so I got a question from Finn West. Let's see here. I don't know if that's popping up on your side, but the question is, can you do another interview with him on the latest strategies he's reviewed? Finn West, if you are watching this now, I'm not 100% sure who him is with the interview. It could have been Mark Guthner. It could have been, I had the quant on from Options Metrics a while back. So I'm not sure who you're referring to, maybe Carter Worth. I could try to get Carter on. Something like that. It's always fun to work with Carter. So we'll check on that. Okay. Next one. Hello, Mr. Mike. How far out in time in Delta would you sell spreads on SPX? Sell spreads. Okay, so I'm assuming. So what a lot of people do to generate income, including one of the people that's helping to produce this program, is selling credit spreads in SPX. Now, I don't personally happen to engage in that strategy. One of the reasons I don't engage in that strategy, though, is because we are typically long SPX options, typically going out 30 to 45 days against a lot of short premium in single stocks. And the total number of single stocks where we're short premium is probably going to be between 20 and I would say maybe as much as 50 individual stocks that we're selling premium on. However, if you are looking to sell credit spreads on SPX, and that's how you're sort of buttering your bread, as it were. You want to keep this stuff pretty short dated. And actually, I know a lot of people who are just in the business of trying to sell dailies. There's actually a hedge fund that's very close to me. I'm not affiliated with them, but they're good guys, longtime options traders. Dipsy Capital, for anybody who happens to be interested, former P-Coast guys. I think one of the guys worked at Parallax Volatility Advisors, which is a big options trading hedge fund. They actually just sell dailies because they try to go out relatively flat, and they don't go out completely flat, but outfits like this they're just trying to collect premium. They're not looking to get blindsided by macro events, trying to control for risk. So keep it short. So the short answer is keep it short. I hope that helps. And as far as Delta is concerned, obviously you're looking to sell out of the money premium, generally speaking. On SPX, it doesn't matter though; it settles to cash. But you don't have to worry about taking assignment. But I think that's short dated, out of the money. Probably 30 Delta or left. Producer Brad, if you're listening, maybe you can relay to me what your preference is on that. Yeah, 15 to 30 is what I'm hearing. He usually does. So just because in my sort of pod of trading, we don't happen to sell SPX for premium, it doesn't mean that people in the orbit in other trading contexts aren't doing it. So 15 to 30 was what he's targeting. Okay. Ranjana Gupta says, I bought Delta at 42. It's now 53. I hold a May 31st 40 strike covered call on it. I don't want to get called away because it's below my purchase price. Should I roll my covered call up and out at a loss or just out at a profit? A little confused because you're saying you bought Delta at 42 and you have a 40 strike covered call. So I guess my takeaway on that is that you were just rolling the covered call. So Ranjana, if you're listening, you can just confirm that. And maybe the stock, let's take a look at when and where this may have taken place and how you got to that spot. So we're just going to go take a look at Delta real quick. All right, so you owned it at 42. This is going back a little further. I don't know how far back in time you were. So 42 was trading around. Perhaps you owned it from last September-ish or in and around this time, and the stock fell, and then you wrote the lower strike 40 calls, and then it ran back through it. So, okay, this is an interesting situation. Let's take a quick look at what something like that would be. So we're just going to create that strategy really quickly for those who are interested. I'm going to sell the 40 strike calls in this thing on May 31st. Okay, so that's what that's going to look like. So payoff for a strategy like that's going to look, let's see, what do we have here? So yeah, basically, you're well and fully through that short strike. So that call, and actually let me just confirm this. I don't think that has any extrinsic value to it at all. It might, but I kind of doubt it. Doubt there's that. No, there's definitely nothing. Okay. So this goes to something I've mentioned on more than one occasion. Whether you're long options or you're short options, do me this favor. When the delta gets north of 60, seriously consider adjusting it. Now, the good news is if you're long stock and short calls and the stock continues to rally, you're not losing money. The issue you have by not adjusting your position, though, is that you are foregoing any additional gains. And now you're in a position which is that you are short the May 31st 40 put synthetically. That's what this looks like. So this payoff profile from here, from today's prices, you can't make any money to the upside. You won't lose any to the downside either. So if you're looking at this chart, and let me see if I can pull my cursor up here. So you'll notice, there's a little faint line right here. This is where we are right now. So from here, essentially down to the strike of the call you sold, nothing's going to happen by May 31st expiration, right? You're not gonna lose or make any money between that strike and infinity, which essentially means that your capital is tied up for nothing. The downside, of course, is that if it runs down through that strike that you've sold, you will take losses on the stock. So at this point, you're in a position that cannot make you money. It can only lose you money. So you don't want to be tied up in this. What I would usually advocate is I would let the whole thing go away, frankly, and maybe just you can sell the whole package tied, and then I might just write some at the money puts, which is you got into this trade for income, and no reason why you can't be in a trade for income. Yeah, you gave up some gains on the way up. And watch those deltas. Once again, I really can't emphasize this enough because there's a lot of circumstances where, forget about Delta, but people in NVIDIA got into situations like this. They sold upside calls, or they had an advisor who sold upside calls. They don't want to get rid of the stock because in their head, they're attached to it, feel like they still own it. They don't want to take a loss, or if it's in a tax-deferred account, they can't contribute additional capital. And so they will sell a longer dated call for almost no additional premium to buy back the short one, and they just get into this position, and the money just becomes dead money. That is not a good situation to be in. You don't want that. So, lesson learned. There's not really much else that can be done about it now. I'd probably sell the stock, get that call back, and maybe write some puts into it if you still happen to like it. Okay. So that is that. Good afternoon, Mike. Thanks for the Albemarle ALB idea. Loving it so far. Yeah, well, that one worked out. I mean, it's funny because I actually came up with that idea. It was that preceding Friday. Stock's obviously up since we talked about it that following Monday. It was up again today. I was just looking at it, 260 or so. I think it was up today. I've actually adjusted. I don't remember which trade specifically I talked about on that live stream. I think I'm in a 110, 20, 30 call spread risky. There's a 120, 30, 40 in Albemarle myself now. And that, unfortunately, I shut that machine down. Yeah, look, 39, it was at 114.92, I think, which is where it closed that previous Friday. It was trading about 39 times the worst 12-month earnings that the company has experienced for any period in the last 10 years, and probably 5 times peak. Battery-grade lithium prices look like they've kind of bottomed out here. So, yeah, I do like Albemarle. Liked it better when it was trading 114.92 than, $130 or wherever it is now. Actually, where is it? Why am I speculating? Let's just take a quick peek. Oops, why did I put Delta? We were just talking about that. 130 spot 82. Actually, yeah, I've got to double check. I may have already run to my long. Okay, so. Oh yeah, did I put that trade? Oh, here. What was this? Okay. All right. Well, we talked about Albemarle, so yeah, good. What do we have here? What are the chances LULU getting below 340? Why is it so cheap? So I guess the immediate question for LULU is, what are the chances of it getting below 340 by when? By what time? So I can give you the probabilities that it gets below various levels, which you can similarly approximate by taking a look at the deltas of various strikes. So that's mathematically, it turns out that the delta and the chance that a stock is below a certain strike price by that point in the future are approximately equivalent to each other. So the chances that the stock gets below 340 by Friday is 15%. The chances that it gets below 340 by a week from Friday is 25. And if you go out much further, let's take a look at the events calendar for LULU. So we'll keep that chart up there for a second. But they are going to be reporting on May 31st. Interestingly, my wife just met the CEO of LULU over the weekend. I was not there though, so I have no insights, and she wouldn't know what to ask, or probably would have thought it was rude to ask. So the only thing I think she said to him was she loves their products. Although lately she seems to like that, is it Biore? I don't know, somebody can tell me, it's some other sports apparel thing. She seems to be more into that now. So they are reporting on the 31st of May. This is a weekly, so we will have May 31st weekly options. Actually, I should have checked. Is that, I'll be able to figure this out in a second, whether they report before or after the close. I'll be able to see that by the vol. It looks like they report after the close. Yeah, it must be after. I didn't look at the calendar, but the implied volatility for June 7th weekly options is actually higher than it is for May 31st. And the chances that it gets below, so let's look out to June 7th. That's the first expiration after they report earnings, which is going to be on May 31st. Actually, wait a minute. They would never be reporting on the 31st because is that, wait, let me see. Yeah, because the 7th is 1 week later, so the 31st is now, that's a Friday. Friday after the close? No, that's not right. So it's probably that following thing. We've talked about this before. There's, not every earnings estimate is correct. You have to wait until the company actually puts it, makes a formal announcement and says, this is when we're going to be releasing. The chances that the stock gets below 340 by June 7th expiration, so that is the week that will capture the next earnings release, is about 37%. However, does that really help you? I don't think that's your question. I think what you probably meant to say, or what you're really looking for, is for me to sort of, well, yeah, why is it so cheap and seemingly getting cheaper? And that actually is a good question too. We'll see. We'll take a look at how cheap it is. So technically, not terrific. Does this? What does this button do? Does that add moving averages by chance? Forgive me. I'm experimenting with some stuff in here. I'm just curious to see. Oh, technically it's kind of a tough story. And this was a Holly Index name forever and remained a Holly Index name until all of a sudden she told me she likes this other, started buying this Biore stuff. And again, if I'm not saying it correctly or pronouncing it correctly, I don't think it's a publicly traded company, but you guys might be familiar with the brand. But it actually is not high up on the Holly Index anymore because she seems to be favoring this other thing. So technically it looks a little bit troubled. What is going on here valuation-wise? So Street is still hoping for 12.2% year-on-year growth. What about quarterly? Slowing growth rate on the top line. Street's hoping for 10% on the top. Less than 5% year-on-year EPS growth, and margins are coming in. And now it's trading. So that's going to get us to, if they are able to deliver the 1406 that the Street's looking for. So we're looking at, 24 25 times earnings. The short version of why the valuation has deteriorated and it's trading cheap to itself, cheap to its own historical multiple, is that top line and EPS growth are slowing. So stock at 350, using, let's call it its 5-year average multiple, the stock would actually be trading actually not that much higher. So using its 5-year average turn to earnings, it would be trading 356.30. That's a rounding error, $6. EV EBITDA, stock would be a little bit higher, so somewhere between 370 and 420. Taking a look at those historical multiples. It's still trading at a premium to the group. Actually, it's interesting because Nike shows up on this list. I was kind of looking at that. That one technically also still looks like it's in a little bit of trouble, but that's a lot cheaper than it has been. Okay. Not a huge help on that one, I understand. So, all right. Interested in Uber, Robinhood, WYNN, ARM, Trade Desk, TP. All right. So let's take a look at some of these names. First things first. Let's take a look at, Uber and Lyft are both going to be reporting. I believe Lyft reports first. I think they report in the evening, and then there's not a trading day between them. I think Lyft is going to report, and then you're going to get Uber reporting the following morning. That's it, if I saw that correctly. So let's just take a look at this. I remember that Lyft was implying some pretty big moves. We can take a look at the chart on Lyft over there. So we've got, could it be implied one-day move of 17.5%? Is that actually right? That seems really big, but could be. So let's take a look at what the price of the 17.5 straddle is. I'm just going to build that in so you guys can kind of get a sense of what that looks like. So that's, remember, you're just choosing the call and put of the same strike and expiration. So stock's about 17.5, $17. That's what I'm looking at. So that's going to give you some sense of what the break evens are. So that's essentially the implied move. Where this is indicated in red, that's essentially the band that the options market is implying that the stock is probably going to trade to on average through the end of the week. So pretty big move there. So what do we got here? So oh, you know what? I'm making annoying noises with this thing. Let me just move this microphone. I've been told that it's making bad noises. Okay. So, technically, most of the short-term technical indicators for Lyft are positive. I'm assuming it's also good looking at longer-term indicators. I know my friend and colleague Carter Worth likes to look at the 150, so we'll take a look at that. It is well above the 150-day moving average, and like I said, several of the other indicators are good. Let's take a look at what the multiples are to itself, to its group, to its growth rate, all that kind of good stuff. 27 times, less than 16 times EV/EBITDA. That makes it considerably cheaper than Uber and DoorDash and all of these others. Street is hoping for, that's a pretty modest rate of growth, but they are looking for positive free cash flow. 17.5% top line and some free cash flow. Did they get any free cash flow in a preceding quarter? I guess they did get some when they reported in December, just under 15 million. We're looking for something comparable now. And now let's just take a look at what the options traders were up to in this thing. So it traded above average volume, calls significantly outpaced puts. The most active contract were the May 20s that expire not this coming Friday, but the Friday after. By the way, if you're curious, when I look at this, am I trying to gauge whether or not people are buyers or sellers? I will, do that in the general case. What I'll do is I'll often take a look at individual prints, take a look at the bid-ask spread right before the trade went off. Where did it trade? All that kind of stuff. But I also just take a look at the implied volatility of the option. If the implied volatility of the option has been rising through time, then we can probably guess that the activity was buying. And actually what I'm going to do now too is I can take a look at the distribution for lift. This is just going to look like the matrix to you guys if I pull this screen on. I'll do it anyway. It's not like I don't worry about this too much. There's a bunch of stuff on here. It's going to be almost impossible for you guys to read it, but we are taking a look at what the option sentiment is going through the next several weeks, comparing that sentiment to how bullish or bearish it was historically, and what that stacks up to sentiment-wise. Again, you're looking at the matrix. I appreciate that. It's just a whole lot of numbers that don't mean much to you. But right now, the stock is, the options market for this week, so coming up this Friday, is in the 88th percentile in terms of its bullish sentiment, 95th percentile for next week. What that means is if you took a look at the entire distribution for this name in its history around earnings, so this is sort of taking a look at the earnings context, you are in a relatively bullish region. So it scores pretty well. Looks like about a 53.3% chance that this stock is going to be higher by the end of this week, based on the distribution. And like I say, we've done a little bit of work on this, and there is statistical significance to how these distributions actually end up playing out in the real world. So looks like the options market's pretty positive, although it's expecting some pretty big moves. Again, 53%, better than 53% chance the stock's higher by the end of the week. Big move, bullish flows. I hope that is helpful. So now let's just take a look at these May 20 calls and see what that looks like if you are going to do that. So I will, I'm going to get rid of the trades that are in there now and put in those calls that were most active, see whether that makes a lot of sense. My guess is probably not my favorite trade. All right, so that's in. Here's the payoff for that. You can see the stock actually has to move significantly higher for that to pay off. Here's a look at the combined, so you just get a sense. It's got to basically, and this is actually probably what these traders are betting on, right? So you're looking at these two prior highs, and they're just making a bet that it breaks out above those two prior highs by, and this was regular way, by the way, so not by this coming Friday, but by the Friday following. Is that the trade I would like? Well, keep your eye on that picture for a second. And let's imagine that we do something a little different. And let's say that we instead, did something like a call spread risk reversal just out of, curiosity. So we're going to do this. I'm just going to go back here, take you to the stock chart. Need to reload that. Playing with these things, we could do this one on OptionPlay. Actually, why not? Pull this up here. Let's do it here. Okay. By the way, also comment if you're watching this. Let us know how you like to see things graphically. We're always experimenting with stuff, trying to come up with ways that seem, maybe more intuitive or interesting. Work in progress, right? So we were talking about a 17.5% move. You bought the 18 calls for May 17th. 20% move on that's going to be $3.40. That gets you up to about 21 bucks. So you could say sell the 21 calls. That is the implied move. And then take the implied move to the downside from 17.5. So that's going to be, we'll call it 15, sell the 15, something like that. So we're going to sell the 15s and the 21s, and you end up with a payout that looks a little bit like that. So you would potentially get long down at this 15 level. You can see where that is. And you'd be selling off your profits up around here. So I'd probably prefer that trade. Just trying to take advantage of the fact that implied volatility is quite high going into the print. Granted, it could be very well deserved. The question of whether options are cheap or expensive is not an absolute thing based on their price. It is actually a function of how much the stock has moved. And the long-term average move for the stock is 13.5%. But recently we have seen some really big moves. We got a 35% move to the upside when they reported back in February. And they, going back to February of 2023, they had a 36% down move. Get a move like that, and these options, as expensive as they are, aren't expensive enough. But my own take is, I've been seeing some responses to earnings recently. Apple is a little bit of an exception, but one of the things I've seen is that, good results have been treated maybe not that well. I think AMD had respectable results, didn't really behave that well coming out of it. Starbucks had obviously very bad results, maybe bad enough that no additional context is necessary, but that thing got taken out and shot. So things to think about. What else we got here? So I just spent a lot of time talking about Lyft. Let's take a look at Uber. What's going on in Uber right now? So Uber is expecting a move of much smaller. Look at that. That's interesting. Less than 10%, according to this. Also, again, above average volume. May 10th, 80 calls, most active. Did those trade on May 10th, 66 puts and the 80 calls? Are those things tied to each other? Let's find out. Any big prints? 5.7 thousand. What's this? So this is a multi-leg trade. So, okay. So let's pay attention to that for a second. May 10th. So that's this week's 66 puts. 5,700 of those traded for 80 cents at around 11. 10:59.35. And I'm suspecting, given the volumes here, that these 80 calls may well have traded as a package with those. We'll find out. No, maybe not. Wasn't those. What did they trade against those? What else could it have been? Oh, these. There it is. Right there. Okay. So at 10:59 this morning, somebody traded the June 14th 62 puts against the May 10th 66 puts. So now the next question is, that's 10:59. Let's figure out what were they doing there. Oops. A sale. They're buying gamma. They're buying gamma. Okay. Somebody was trying to buy these 66 puts. They wanted to find something they could finance against it. They're trying to make a bearish bet. They basically put that thing on for no premium. And let's take a look at what that looks like. So I'm going to do that in both applications so we can kind of get a sense of what that looks like. Interesting. All right, so Uber, 5,700 times. They bought May 10, 66 puts, and they sold the June's 62s against it. Looks like they got this thing off somewhere in the middle. All right, so you get a payoff profile that looks a little something like this. This is a bit deceptive. Well, actually not really. So this is $8. 8 cents is what the mid-level prices were assumed to be for that. Let me see if I can, I'm going to see if I can pull this up on the other application. We'll see what how it represents graphically. But basically, if you'll notice here, so this P&L, what you're dealing with here is that if the stock declines to, but not through the strike of the put that you own, it's basically saying that that longer dated option is going to go up in value. Now there's a vol crush that's associated with this. So in truth, that longer dated option it's true that it would appreciate because of the decline in the stock price, but it is also true that it's going to decline in value due to the decline in implied volatility. That's the premium of that option. So I think what's going on here is somebody's just putting this trade on, figuring that if you get a disappointment, the move to the downside is going to be meaningful. And 66 is 7.5%, give or take, down from where the stock is currently. Have we seen moves like that recently? I have another colleague who loves these kinds of trades when he wants to essentially own gamma. He wants to own the short dated option. So what they'll do a calendar, sell a longer dated option, but not long enough to capture other events, hoping that the vol crush will help pay for it. Usually trying to get into that trade for no net premium outlay, or even in some cases a slight credit is the idea. So you don't see these kinds of trades that often, but you will see them from time to time in cases like this. So taking a look at Uber earnings, we've had over the course of the last 8 reported quarters, 3 of those moves were double digits, although they were double digits to the upside. So we had the November 22nd Q3 22 report up 19, following quarters up 12, and then 2 quarters after that, stock rose 11.5%. So on the institutional side, it would appear that you've got some folks who are looking to get some gamma going into the print. And again, you can't really do that in Lyft because Lyft is already implying a 17.5% move, but Uber implying about half of that. So that's probably the reason they're doing that trade. So hope that is helpful or interesting. What was next that we were going to take a look at? I think you wanted to know about Robinhood. Oh yeah, Robinhood's kind of an interesting case. So what do we got here? So they're going to be reporting, was on my list of big implied moves for the end of the week. More than 12%, not surprising, moved double digits the last 2 reported quarters. So you're going to expect to see some moves out of that. But if I remember correctly, they got I thought I saw this morning when I was looking at it, that they had a notice from the SEC, which I mentioned earlier in, they got a Wells notice. So a Wells notice is basically a formal notification from the SEC that they're involved in an SEC investigation. This one related to crypto space. So what we saw in the options market today, which is more than 2 times the average daily options volume, is probably related not just to the upcoming earnings, but also to that. Most active contract, May 10th, 16 puts. I'm sure that they will probably, well, they're certainly going to be asked. I don't know what they're going to be completely at liberty to say. They might have their hands tied. They'll probably have they'll probably make a statement on the earnings call, is my guess. I am going to guess further that counsel's probably going to advise them not to say a whole lot more than whatever prepared remarks they have. So keep an eye out for that. It was the May 16 and 15 puts that were most active. Over 10,000 of these May 16 puts traded. And that's May 10th, 16s, by the way. So these expire at the end of the week. That would be a big, big move. Yeah. Okay. So, and let me just take, you know what else I'm going to do? Give me a second. I probably have sentiment data on this one for week's end. Let's see what that looks like. Yeah, in the buy, sell, hold category for the end of this week, it gets a 62.8. You can kind of think of this as a score like that as what it would be if it was your high school algebra class. Maybe 60 and above is passing, but I mean, this is D- territory for the end of the week for Robinhood in terms of option sentiment anyway. So what that's doing is taking complete look at all of the options that traded in Robinhood, creates a price-weighted probability distribution for the expiration that you're looking at, and then you rank it relative to itself in terms of bullishness. And yeah, the short version is not great. Not great for Robinhood going into the print. Okay. What else do they have here to look at? Probably quite a few things. Okay, let's see here. Here's a general question. Mike, I don't see you ever using butterflies. Do you use them in your own fund? Why or why not? Okay, first of all, own fund. It's the pool of capital that I'm responsible for is actually not my capital. It's external capital that we're running, and the short version is no, we don't typically trade butterflies. We could get into butterflies synthetically from time to time, just as a function of managing around a position. We may end up in situations where we're much more likely on the single stock side to be short put spreads, short covered calls, maybe short call spreads. Sometimes actually net short calls naked, so willing to actually get short the stock to the upside. Not terribly often, but that does happen. I just don't end up trading butterflies, I guess in part because we don't really need to from a margin perspective. Occasionally in stocks that have wider bid-ask spreads, the execution becomes a little bit cumbersome if it doesn't trade through the complex book right away. A complex book, by that I mean you construct the strategy, you just throw it over the side and look for a fill. We've often found that we get better fills and more timely fills trading option strategies leg by leg. So one trader might be trading one piece, another trader might be handling the other, and they're kind of getting the thing in that way. So it's true. We don't trade them that much, but doesn't mean it's a bad idea. It just doesn't happen to be, what matters on that. Mike, can you talk about BlackRock? What is your conviction on the direction of the stock and what type of option structure would best capture it? Okay. I don't think that was on my list of big earnings reporting names, but since you're asking, why don't we have a peek? They're going to be reporting on they reported April 12th, so the next earnings report is on the 15th of July. They have, so the stock goes X on the 4th. On the 15th, so 9 days from today, they're going to have their annual general meeting. You know, is that a catalyst or not? Take it as you will. Look, they're a Goliath, arguably the Goliath. So they, you know, it's an effective and well-managed business. They're the leader in the space. Their issue, I guess they have a couple potential issues. One of those issues is that, you know, their business is, they compete more on fees than some other businesses do. See what their multiple looks like. Come over here. I'll just take a quick peek. Actually got a, you know, their price analysts have actually bumped their price targets a little bit higher over the course, nothing over the last week. That's not surprising, by the way. You know, I was just talking to somebody else about this. You know, analysts are marketing too. I'm talking about Wall Street, you know, research analysts. And there's a couple ways you can stand out as a research analyst. One of them is to, you know, have a view that differs from the street quite meaningfully. So the guy that has the highest price target or the lowest changes your ratings right before an important catalyst. You know, if you hold a big block of stock and you see a street analyst come out a week or two before a company's about to report results and they meaningfully change something, it's pretty likely that you're going to get at least a couple phone calls about that. A couple holders from active managers are going to say, "What, you know? Okay, why'd you do that? Why'd you raise your price target, or why'd you lower it just before the print? You know, why would somebody do that when you know that management is about to give you an update on the operating results?" So what that means is that you end up in a little bit of a black hole from time to time, where you're not necessarily going to get a whole lot coming out of, you know, sort of the street on a name between events. I'm actually going to quickly look at this and just see what our sentiment on this one is as well. So on a multiple basis, looks reasonable. 18 times. I mean, that's kind of expensive compared to a lot of other names in the group, but I mean, when you consider their dominant position, not terrible. Option sentiment this week, next. It's pretty mediocre. But I would also point out that will sometimes happen when you have a lot of strength. So if a stock is trading higher without a lot of news, and it traded higher today, no real news that I'm aware of. Yeah, I guess I would call it call this one a pair of twos. You know, in fairness, I should say one other thing, which is that, you know, everybody who's in the industry, you end up with a different sort of potential take on a name. You know, I'm not hugely enthusiastic about some of the things I've seen come out of the company in some other contexts. Doesn't really reflect on their operating results at all. Competitive space, fair multiple. you know, cuts the middle down on the technical side and option sentiment also. So not a huge help. I appreciate that. But if you are in the name, you know, one thing you could consider doing, because I don't think this one is hugely volatile. No, it isn't. You know, this one might set up for something like a poor man's covered call strategy. You know, own longer dated calls in it. You know, try to sell some near dated premium, particularly excluding those catalysts. Let's take a look at the term structure. Term structure is, yeah, flat-ish. So this is the near dated. This is the longer dated. Yeah. Okay. It's here's somebody who knows the brand that my wife mentions. It's Vuori, V-U-O-R-I. Okay. All right. So that's one for us to look at. I don't think there's a stock on that. I have Uber shares sold the 78 calls and bought the 517 put spread 69.66 with a net credit. Any changes to make? No, I like that trade actually. That sets up pretty well. Yeah, you didn't tell me what expiration that is, but if I've got this up on OptionPlay such that you can see it, this is good. So May 10th. Oh, actually, you have a little bit of a diagonal. So you sold. Oh, look at you. Nice. Okay. All right. I see what you're doing here, and I like it. May 10th, you were selling. So that's expiring this week. So you're just basically trying to sell that options premium expiring this week. Gave yourself a little bit more time for that put spread to pay off. So you bought the May 17th, 1 week later. Bought those 69 puts. Those are just out of the money. Nice and tight. So that should kick in pretty handily. This is also the May 17s. And you sold the 66s. So that trade's going to look like that. And that, by the way, this is against a long stock position. So look what you get. You get a... So did I make sure? I just want to make sure I have that in right. Long the 69, short the 66s. That's 90. So that, yeah, you're doing that for essentially even money, right? Gives you upside up to 78, which, by the way, is on or about that implied move. Remember, I think we said the implied move was about 8%, stock 71.5, so that's going to be up 572. So yeah, you're right there. So basically, you're taking that implied move up and down and saying you want to have some insurance on a portion of that implied move down, $3 of it, which is about half of the implied move down if it goes that way, and get most if not all of the implied move up. So yeah, good trade, like it. Okay. My vote is the OptionPlay platform. Okay. So we will use that until somebody else says otherwise. I do think that being able to chart where the P&L is on a clean graphic is also helpful. So maybe from time to time we can talk about that. And actually, looking up here, I realized I've had you guys once again for over an hour. My ability to chew up the clock is remarkable. But I thank those of you who stuck with me for this period of time for doing so. If you had a question and I didn't get to it, I will try to, when we join you again, which we will do the day after tomorrow, Wednesday, at 4:15 Eastern. I hope you tune in for that one as well. Thanks for watching.